Hi, everyone. Today we're going to take a look at options, and today specifically about what a call option is. Now, there was a comment on a recent video saying this would be great if I could understand any of it. Can that kid that does videos on Patreon maybe do another one of these? So yes, this one's for you. I think call options in general are very powerful, but they are leveraged, and so with any type of leverage. With any type of new strategy, you really need to know what you're doing before you jump in. So hopefully we can go through the basics, and after this, you'll understand what a call option is. Okay, so what are options contracts? According to Investopedia, an option contract is an agreement between two parties to facilitate a potential transaction involving an asset at a preset price and date. This will make a whole lot more sense as we continue to go through some examples, but there are some key points that I want to point out here. Number one, this is a zero-sum game. There are two parties that are in agreement on something. For every buyer, there's going to be a seller. So, as James always says, zero-sum game. If you are betting long, someone is betting short against you. Okay, if you think price is going to go up, someone thinks the opposite and price is going to go down. So you are buying a contract from somebody that thinks the opposite of you. Really important, okay? So you got to know what you're doing. Number two, this is just a potential transaction. All this means is you have a contract. Whether you follow through or not on that contract is up to you. Okay, and again, we'll talk about that more in a second. There's also a preset price. This will be your strike price. Okay, so for example, Tesla, let's use $270 as an example. If you buy the 270 strike, that means your agreement with that person is you can buy shares for $270 no matter what the price is in the future. Okay, so there is a preset price determined when you purchase the option contract. And then last, there is a preset date as well. So there is an expiration date that you have to pick. We often want to pick the longest term possible to give ourselves the most time for our bet to the upside or to wherever direction to work out. Okay, so preset date as well. There's an expiration date. Unlike buying a regular stock where you can hold it, you could hold Tesla for the next 100 years, an option contract has an expiration date. Let's take a look at a real life example using a house. Let's say that you find a house that you like that costs $500,000. You're not ready to purchase it yet because you're unsure of what's going to happen in the economy. Okay, you're not sure if it's going to go up or if it's going to go down. However, you love this house and you want to lock in your price. You think $500,000 is a fair price. What you can do is you could go to the seller and you could say, hey, I'm not ready to buy the house yet, but how about I pay you $50,000 and you hold that price for me? Hold 500K. Okay. I could also say, how about you hold it for 2 years and I'll pay you a little bit more. I'll pay you $75,000 instead. Okay. So what are the outcomes of this contract? So number one, where this would win. If price of the house goes up to 600K, you would have profited $50,000. Why? Because you get to purchase the house for $500,000, but you also paid $50,000 to enter into that agreement. So really you only profited $50,000, but that's a winner. Okay. The next scenario would be price goes to 525K. So price still increased, but this would actually be a $25,000 loss for you, right? You purchased the 1-year contract costing $50,000. Price went up to 525. So you would say, hey, I won 25,000, but not quite because you purchased the contract for 50,000. So that would be a $25,000 loss. The next scenario would be what happens if price stays the same? Well, if price stays the same, you lost out on that insurance, right? You kind of lost out on that $50,000 that you put up because you were anticipating the market to go up. Okay, market didn't go up. You paid $50,000. House is only worth $50,000. So that contract would expire worthless. And then the final scenario is if price is below $500,000. If it's below $500,000, why would you execute on your plan to purchase the house for $500K? If it's $400K, well, you might as well just go and buy the house straight out for $400,000. Okay, so that contract would also expire worthless. Okay, let's take a look at a stock example now. This is the options chain on Robinhood. Taking a look here, I have a strike price of $270. my break-even point, we'll talk about that in a second, and then the ask price. This is how much you're going to pay for that contract. And of course, up here is our expiration. So this is 8 days to expiration. Okay, not a lot of time here. So again, 270 strike means what? We have the right to buy Tesla shares at 270 anytime between now and expiration, no matter what the price is. Okay, and to enter into that contract, it will cost me $9.25. That means you are essentially buying Tesla shares for $279, right? 270, what we agreed on, plus the premium that you decided to pay for it. Okay, so that's where our break-even number comes from. As long as price is above 279 at expiration, we have made money. Okay, now wanted to point out one more thing here. This is, look at the expiration date. This is now in 2027, 833 days to expiration. It's the exact same one, the 270 strike, but 2.5 years out, and this is going to cost me $100. Okay, so 10 times the price, over 10 times the price, which makes sense, right? We're paying for more time for this to work out. All right, so let's go through a few examples here. Starting on the left-hand side, what would be a winner? And again, this is going back to our 8-day expiration. 8-day expiration. Okay, our strike price is 270. If price goes to $300, okay, so you would say, hey, I made $30 per share. Almost, right? So $300 minus my strike of 270, I made $30 per share. But I paid $9.25 for this. Okay, so $30 our profit minus $9.25 what we paid. So really, you profited $21.75 per share. Okay, so that would be a winner. Let's go through why 279 or 280 is our break even. Okay, the stock price is 280 at expiration. I then subtract out what my agreement was, which was to buy at 270. So I made $10 per share. But remember, we paid $9.25 for it. So really here, you only made 75 cents per share. We can just call that break even, right? Okay, there's also a partial loss. So let's say that price expires above 270, but below our break-even price. Okay, so let's say 275. So 275 minus 270, I made $5 per share, but I paid $9.25 for it. So I lost $4.25 per share here. So I didn't lose the full amount. I lost about 50% on that trade. Okay, and then the last thing would be anything under our strike price will be a full loss. Okay, anything under our strike price will be a full loss. So the maximum you can lose on this is what you paid. Okay, again, we're just trading contracts here. We're trading an agreement here. Now this makes sense again because let's just say that price expires at $269, $1 below our strike. Well, why would I go through with this deal? Why would I want to go buy shares with my contract at 270 when I could just go to the marketplace and buy them for 269? Okay, and of course this example continues to roll down. If shares are worth 250, price is $20 per share less than your strike. So again, why would you go through with your deal and say, oh yeah, give me those shares for 270 when you could just go to the marketplace and buy them for 250? So if that happens, your contract expires worthless, okay? Because there's no value in that. Why would I execute at 270 when I could buy at 250? All right? So these are the examples of what can happen. Okay, so why should we care? Let's take a look at an example. If I were to just buy stock, let's say the current Tesla price is 270. I buy 100 shares at 270 each. That would cost me $27,000. Okay? Price goes to $1,000. Let's just pretend. Price goes to $1,000. Okay, so my profit would be $73,000, right? Right, I have 100 shares at 1,000 each. That's $100,000, but my investment was $27,000. Okay, so I have a profit of 73. My ROI is 285%. Pretty good. Okay, let's take a look at buying an option instead. Current Tesla price 270. Instead of buying 100 shares, how about I buy 2 contracts? And each contract is going to cost me $100. Okay, so we have to remember too that options contracts control 100 shares. So if the options chain says $9.25, $9.25, we got to multiply that by 100 because that's per share. So really this would have cost you $925. Okay, so if it says 100, it costs $100. It really costs $10,000 per contract. Okay, so I'm going to buy 2 contracts for $20,000, but now I'm controlling 200 shares instead of 100 shares in this example over here. Price goes up to 1,000. So let's do some math here. Price is 1,000. I subtract out my strike price, which was $270, but I also have to subtract out how much I paid, the premium, which was $100. Okay, and then if I multiply that by 100 over 100 shares, I would have $63,000 in profit. Okay, so this is for one contract. So you can see here, you would say, well, 73,000 is more profit than this. But remember, we bought 2 contracts for only 20,000. So we have to multiply that by 2. So I get 126,000 in profit from buying 2 options contract, which only cost me 20,000 instead of 27,000. So our ROI is 530%. This is a much higher return for investing less. So now you can think, well, what if I bought 3 contracts, right? So I would only pay 3,000 more to get 3 contracts. And now we're talking in the range of 180,000 in profit. Okay. So I hope everyone followed here. Point being, it is leverage. You're going to pay less to still control 100 shares, and you get to keep all the profit from it. Okay. So in summary, a call option is a contract that allows the buyer to purchase shares of a stock at a certain price with a certain expiration date. Okay, so number 2, there is an expiration date. Number 3, contracts control 100 shares. 4, you pay a premium for that option contract. You have to pay for that right, for that deal that you get to buy, or you get to lock in your price and you can buy at a later date. Okay, your break-even price is going to be your strike plus your premium paid. Okay, so that's number 5. Break even is really important to know. Strike plus whatever you paid for that contract. Okay, number 6, if price at expiration is below the strike, then your contract will expire worthless. And last, of course, with leverage, there's going to be greater returns, but there's greater risk. Okay, so I hope that was helpful. Options contracts can be extremely, extremely powerful, but you got to know what you're doing because it is leverage. Okay, that was a call option, a long call option. Let me know if you have any questions down below. I'll do my best to answer them, and I'll see you all next time. Bye-bye.